A couple weeks ago, I finally finished reading a book that I've been trying to put under my belt for a while. So it's Common Sense on Mutual Funds by John C. Bogle. It's about 600 pages. So John founded Vanguard in 1974, and he created the first index fund in 1975, and they've been gaining traction ever since. But what's so great about an index fund is that it's low cost and basically helps you retain more of your earnings than, say, something like a mutual fund where you have to pay more of an advisor fee. So some of the things that he talks about in this book is like risk, and he kind of makes some cases for buying like large cap funds, and maybe getting a little bit less reward out of those. He says that's worth it compared to the amount of risk you take for something like a small cap fund. There's the idea of reversion to mean, where say a stock is growing in value and it's like the best growing thing out there right now. Well, there's probably going to be a day where it comes down even harder, and basically they kind of all average out. He mentions that time, of course, is a very important variable in the growth of stocks over time. If you have it growing for 40 years versus 20 years, has a lot more time to grow, compound interest, that sort of thing. So kind of just a reminder with that recurring theme in investing. It brings up a bunch of terms. I'll let you guys look into these more on your own if you want to, but I'll just kind of bring them up here. Stocks, bonds, ETFs, exchange traded funds, Sharpe ratio, basis points, mutual fund, expense ratio, price to earnings ratio, prospectus. And also, hopefully, you know the idea of like a bull market versus a bear market. Right now, we've been in a pretty long bull market, so it's just been shooting up, and values have been increasing. And I'm actually kind of curious. Everyone's kind of thinking like, when is it going to come back down? So that'll be interesting to see here. Probably the next year, I'm guessing. No idea. No one knows, but we'll see. And since he created Vanguard, he talks about wanting to have the lowest fees kind of in the industry, because the brokerage, even though it is in business to make money, I mean, they're out there to serve customers too, and the best way to do that is by reducing the amount that they charge in costs to the customers. So that's really cool how, being the founder of that company, he tries to put the customer first and reduce the company's costs on them as much as possible. Talks about marketing costs, how with some funds they spend so much money in trying to bring in new customers, they're basically spending some of the profits on the existing customers in order to make themselves more money, when they should be serving the customers and giving them their money back instead of trying to grow their own business. And with the growth in technology, pretty much anyone should be able to educate themselves a lot and be able to pick good funds. Maybe unlike the way you could before 2000 or whatever, but there's just so many ways to educate ourselves now that everyone should be taking advantage of that if they want to get the most out of their investing as possible, like reading the prospectus and looking at history, reading about advisors and all sorts of different things. So if I was going to give this book a rating out of 5, I would give it a 4.5 out of 5. I mean, I don't read much, but I would say this book is definitely worth a read if you want to get more into investing and learning about it. I thought it was great for me, so many different topics and that type of thing. Yeah, it took me a while, but I almost want to read it again. But I only take off a half a point, giving it the 4.5, because there is a little bit of repetition. How much he mentions index funds, but maybe that's just to drive the point home of how important index funds are. And also because of the links, I don't know, 600 pages is quite a bit. I don't know if you can condense that down a little bit, but I think it was still a great book to read. So this has kind of inspired me to kind of further my learning with index funds. I did put a little bit of money into a Schwab index fund. It's like their S&P 500 index fund. The code is SWPPX, and the expense ratio is only 0.03%. So that's pretty awesome. I hope you guys learned something in this video. Maybe give it a thumbs up, or like, whatever, comment, subscribe, and we'll see you next time.